It's October 2008. The global financial system is collapsing. Lehman Brothers has just filed for bankruptcy. Trillions of dollars are evaporating from the stock market. Panic is everywhere. But one man saw it coming years before anyone else. While Wall Street CEOs were still collecting million-dollar bonuses and telling everyone the good times would never end, this economist was screaming from the rooftops that disaster was imminent. They called him a doom merchant, a perpetual pessimist, someone who just didn't understand how the new economy worked. Then, everything he predicted came true. His name is Nouriel Roubini, and his story isn't just about being right when everyone else was catastrophically wrong. It's about understanding the patterns that keep destroying fortunes and why we never seem to learn from history. Let me take you back to September 2006. The setting? An International Monetary Fund meeting in Washington, D.C. The mood? Optimistic. The housing market is booming, unemployment is low, and America's economy seems unstoppable. Then Roubini takes the stage. He doesn't congratulate anyone. Instead, he delivers what one attendee later called the most depressing presentation I've ever heard. He predicts that within 2 years, the United States will face the most severe financial crisis since the Great Depression. Home prices will collapse. Major financial institutions will fail. The recession will be deep and prolonged. The audience's reaction? Polite skepticism at best, outright dismissal at worst. The IMF's chief economist at the time actually joked that a recession is something that happens every 5 to 10 years, so you can't always predict it won't happen. But Roubini wasn't just making a vague prediction. He laid out the exact mechanics. Subprime mortgages would default, housing prices would plummet, mortgage-backed securities would implode, and the contagion would spread throughout the entire financial system. 18 months later, it all happened exactly as he described. Bear Stearns collapsed in March 2008. Lehman Brothers followed in September. The Great Recession had begun. Suddenly, the man dismissed as Dr. Doom was the oracle everyone wanted to hear from. So how did he do it? Was it luck? Some kind of mystical intuition? Actually, it was something much more mundane and much more powerful. He studied history. Roubini, born in Istanbul to Iranian Jewish parents and raised in Italy, understood something that many American economists had forgotten. Financial crises weren't aberrations, they were patterns. And these patterns repeated themselves with eerie consistency across different countries and different centuries. Before his 2008 prediction, he had already correctly forecasted the Asian financial crisis of the late 1990s. While working at the US Treasury and IMF, he watched as the same warning signs appeared. Excessive borrowing, unsustainable asset bubbles, and dangerous levels of leverage. His method wasn't complicated. He looked for what economists call the 3 deadly sins of finance. First, excessive debt accumulation, both public and private. When everyone's borrowing more than they can realistically pay back, something has to break. Second, asset price bubbles disconnected from fundamental value. When people are buying houses or stocks not because they're worth it, but because they expect someone else to pay even more tomorrow. Third, excessive risk-taking by financial institutions. When banks are making bets they can't afford to lose, using money that isn't really theirs. Sound familiar? It should, because Roubini has been warning us that we're seeing these same patterns emerge again. But here's what makes his story even more interesting. Being right didn't make him popular. Even after 2008, many in the financial establishment resented him. They called his warnings alarmist. They said he was talking down the economy. Some suggested he was personally benefiting from creating fear. There's a fascinating psychological phenomenon at play here. You'd think that someone who accurately predicts disasters would be celebrated and heeded. But that's not how it works. Roubini faced what researchers call Cassandra syndrome, named after the Greek prophet cursed to speak true prophecies that no one would believe. When someone consistently warns about problems before they happen, people don't thank them. They shoot the messenger. Why? Because accepting that a crisis is coming requires painful action. It means admitting mistakes, changing behavior, and accepting short-term pain to avoid long-term disaster. It's psychologically easier to dismiss the warning and hope for the best. After the 2008 crisis, Rubini continued his pattern recognition. He warned about the European debt crisis before it exploded in 2010. He identified the risks in Chinese shadow banking before it became a major concern. He cautioned about rising corporate debt levels that would become dangerous during the next downturn. And then came COVID-19. In early 2020, when many economists were still predicting a V-shaped recovery and saying the pandemic would have minimal economic impact, Rubini was again among the first to recognize the scale of the crisis ahead. He called it a Greater Depression scenario, not because of the virus itself, but because of the massive debt burdens and structural weaknesses that had been building for over a decade. The market crash of March 2020 proved him right once again. So what can we learn from the man who keeps predicting crashes? First, understand that optimism isn't always wisdom. Wall Street has a built-in bias toward bullishness because that's what sells products and generates fees. When everyone around you is saying, "This time is different," that's exactly when you should be most cautious. Second, history doesn't repeat, but it rhymes. The specific triggers change: tulip bulbs, railroad stocks, dot-com companies, mortgage-backed securities, cryptocurrency, but the underlying psychology remains the same. Greed, fear, leverage, and the delusion that fundamental economic laws don't apply anymore. Third, the cost of being wrong about a crisis is vastly greater than the cost of being cautious. If Rubini had been wrong in 2008, some investors would have missed out on a few years of gains. Because he was right and people didn't listen, millions lost their homes, their jobs, and their life savings. Today, Rubini continues to warn us. He points to mounting government debt, zombie companies kept alive by cheap credit, dangerous levels of inequality, and the destabilizing effects of climate change on economic systems. He's particularly concerned about what he calls a stagflation scenario, where we get both economic stagnation and high inflation simultaneously, something that's even harder to fight than a regular recession. Will he be right again? Maybe, maybe not. But here's the thing about Rubini that makes his story so compelling. He doesn't predict crashes because he's pessimistic. He predicts them because he pays attention to what actually matters: debt levels, asset valuations, systemic risks, rather than what people want to hear. In a world of relentless optimism and short-term thinking, having someone willing to sound the alarm might be the most valuable thing of all, even if nobody wants to listen.